Several of you have been asking the same question in the comments this week. Why does everything feel more expensive right now, even though I just got my tax refund? Today, we are going to answer that with 5 specific things happening simultaneously that the mainstream news is not connecting. This is Go Finance. Here's the situation on the ground right now for the average American household. The Iran war began February 28th. Gas prices have jumped 90 cents in just 19 days. That is one of the fastest spikes on record. The national average is now $3.94 per gallon and rising. A household with 2 cars is spending an average of $20 to $40 more per week on gas than before the conflict started. Collectively, American drivers have pumped nearly $4.5 billion more into their gas tanks since February 28th. $4.5 billion in 3 weeks. Money that is not going to restaurants, not going to clothing stores, not going to savings. Left behind at the pump? 5 stories, 5 connected data points, 1 conclusion. Let us go through each one. Story 1. Your tax refund is being eaten alive. Trump's tax cut legislation delivered real money to American households this year. The average tax refund is up $355 compared to last year, averaging $3,676 according to the latest IRS data. That was the good news. Here's the bad news. Researchers at Stanford calculate that gas prices could peak in May at $4.36 a gallon based on Goldman Sachs oil price forecasts. At those prices, the average household will pay $740 more in gas this year. $740. The average tax refund increase was $748. The math is brutal. The entire benefit of Trump's tax cuts for the average American household is being wiped out dollar for dollar by the gas price spike from the Iran war. Lower and middle-income households are hit hardest because they receive smaller refunds while spending a larger share of their income on gas and energy. The energy shock is going to hit those who have the least cushion. And it does not look like those tax refunds are going to be here to save them. Story 2. Gold just had its worst week in 15 years. Gold dropped 9.6% this week, its biggest weekly loss since September 2011. Silver dropped more than 14% over 3 straight losing weeks. Silver futures fell to $69.66, the lowest closing level since December. Both metals are now down significantly from their January highs. If you are a stacker watching this, you need to understand why this is happening, because the reason matters more than the number. The Iran war sent oil to $115 a barrel. That energy spike is feeding into inflation. When inflation goes up, central banks cannot cut rates. When central banks cannot cut rates, the opportunity cost of holding gold and silver goes up. Paper traders flush their positions. The price falls. But here is what the price is not telling you. Physical gold premiums stayed elevated throughout the sell-off. The physical market and the paper market are telling 2 completely different stories. The paper price crashed. The physical demand held. That gap always closes. And it never closes in the direction of the physical market coming down. Story 3. The $39 trillion milestone nobody is talking about. The U.S. national debt crossed $39 trillion this week. That number arrived during an active war with no end in sight. Washington added $1 trillion in gross debt in less than 5 months. Annual deficits are closing in on $2 trillion, roughly twice the level economists consider sustainable. White House advisor Kevin Hassett estimated the early phase of the Iran conflict could cost more than $12 billion. Historically, initial estimates like this dramatically understate the full cost once operations extend beyond the opening phase. The Government Accountability Office puts the real-world impact plainly. Rising debt means higher borrowing costs for mortgages and car loans, lower wages, as businesses have less to invest, and more expensive goods and services. This is not an abstract budget problem. It shows up in your monthly bills. At the current pace, $40 trillion arrives before the fall elections. Story 4. The Fed is trapped, and Powell admitted it. The Federal Reserve held rates steady this week and projected just 1 rate cut in 2026. Jerome Powell made a point of telling markets, this is not the 1970s. Not stagflation, not double-digit unemployment. He nudged the GDP forecast higher, from 2.3% to 2.4%, and sees unemployment holding steady at 4.4%. He described tariff-driven price pressures as temporary. His bet is that inflation fades the way COVID inflation eventually faded, just later than expected. But here's the tension that Powell cannot resolve with a press conference. Oxford Economics just cut its U.S. growth forecast for 2026 from 2.5% to 1.9%, specifically because of the war. Bank of America data released Friday showed that spending on gas on its credit and debit card shot 14.4% higher in the week ending March 14th compared to a year ago. Before the war, that spending was running 5% below the prior year. A benefit to consumers. That benefit has been reversed completely in 3 weeks. Consumer spending on everything else is still growing, but showing no signs of the acceleration economists had predicted. The longer gas prices persist, the more they gradually sap consumer discretionary spending. Powell can say it is not the 1970s. The gas pump is telling American households something different. One more detail that markets are beginning to price. Powell confirmed he is not resigning and may serve as provisional chair if his term expires before a successor is confirmed. Kevin Warsh, the hawkish Fed chair nominee, is waiting in the wings. If Warsh takes over with oil above $100 and inflation above target, the probability of rate cuts does not go up. It goes down. Money markets are currently pricing no cuts in 2026 at all, with the first move expected in the first half of 2027. Story 5. Silver is down, but the physical market says something different. Silver at 69.66 is down more than 14% over 3 weeks. If you read the headlines, the silver story is over. The metals trade is unwinding. The safe haven is dead. That is the paper market talking. Here is what the physical market is saying. The gold to silver ratio is now at approximately 67 to 1. Gold at $4,660, silver at $69. The historical average of that ratio is 47 to 1. At the historical average, with gold at $4,060, silver would be at approximately $99. Silver is historically undervalued relative to gold right now by approximately 30%. JP Morgan sees silver averaging $81 an ounce in 2026. Solar panel production is up 18% year over year, driving industrial silver demand that does not respond to paper market sell-offs. Manufacturers who need silver for solar panels, semiconductors, and electric vehicles are not looking at the futures screen and deciding to use less silver. They need it regardless of price. 6 consecutive years of structural supply deficit. More silver consumed each year than mined. That deficit is not resolved by a paper market flush. Now let us connect all 5 stories, because this is the part nobody is doing. The Iran war started February 28th. It sent oil to $115. That oil spike is eating American tax refunds dollar for dollar. It is killing discretionary consumer spending. It is keeping the Fed frozen with rates at 3.5% to 3.75%. It is driving the paper, gold, and silver sell-off because high rates make holding non-yielding metals expensive. It pushed the national debt across $39 trillion with a war bill that is growing. And it is doing all 5 of these things simultaneously to the same American household. The family filling up in Oklahoma this week, the one cutting back on groceries to pay for gas, the one who is counting on that tax refund for property taxes. That family is living all 5 of these stories at the same time without knowing they are connected. That is why we cover this every day, because the paper price of gold and silver on a screen does not tell you this story. The data does. If you are a stacker watching this from anywhere in America, drop a comment below, tell us your state, and tell us how much more you're paying at the pump this week compared to February. I read every comment. I will pin the best ones. The physical market held through the paper sell-off. The structural case is intact. The $39 trillion debt does not go away when the war ends. The energy transition silver demand does not go away when the futures market flushes. And the gap between the paper price and the physical reality always closes eventually. Data before price. If you want this analysis in your inbox every morning before markets open, join the Go Finance newsletter. Link is in the description and in the first comment below. Subscribe. Turn on notifications. Go Finance.